Doreen opened her post one Tuesday morning and found a letter from the Department for Work and Pensions, asking her to explain a deposit of £4,000 that had landed in her account 8 weeks earlier. She hadn't done anything wrong. Her sister had died and left her a little money, and the solicitor had paid it straight into her bank. But Doreen didn't know that mattered. She'd been claiming pension credit for 3 years, and nobody had ever told her a letter like this was even possible. She'd kept every letter from that solicitor for years out of habit, but it never once crossed her mind that keeping them mattered for her benefit claim, because nobody had told her the two things were connected. She rang her daughter in a panic. Her daughter rang me, and by the time we'd sorted it out, 3 weeks and a great deal of unnecessary worry later, Doreen understood something I wish every pensioner in this country understood before it happens to them, not after. The DWP can and does look at your savings if you're claiming certain benefits, and the rules about how much you're allowed to have, what counts, and what happens if you go over are nothing like what most people assume. Some of what you've heard is true, some of it is badly exaggerated, and mixing the two up is exactly how honest people end up frightened over nothing, or worse, caught out over something they should genuinely have declared. So today, I want to walk you through exactly how much you can have in savings before it touches a DWP benefit, which benefits actually look at your money, and which never go near it, what the department can and can't see, and one particular mistake, a well-meaning one, that causes more trouble than almost anything else in this entire area. If this is useful so far, and really helps this channel reach the people who need it, and do tell me in the comments where you're watching from, I read every one. The single biggest misunderstanding I need to clear up first is this. Your state pension is not means tested. Whichever version you receive, the new state pension, the old basic state pension, or the additional state pension, a lot of you built up under the previous rules. It makes no difference if you've got £50 in the bank or 50,000. Your state pension arrives at the same rate either way, because it was built up through your own national insurance contributions across your working life, not handed out based on need. If your state pension is the only thing you receive from the state, nobody at the DWP is looking at your bank balance, because there's nothing for them to look at it for. The same goes for attendance allowance, the benefit that helps with extra costs if you have a disability or health condition and have reached state pension age. It doesn't look at your savings at all, and it isn't affected by your income either. It's based purely on the level of care or supervision you need, so if you've avoided applying because you assumed your savings would count against you, that particular worry doesn't apply here. Where this changes is with the benefits that sit alongside the state pension, the ones designed specifically to top up people on a lower income, and it's here that savings start to matter. The main one is pension credit, and if you're not already getting it, this section is worth your full attention, because the rules are more generous than most people assume. Pension credit looks at what's called your capital, meaning savings, investments and cash you hold, and the first £10,000 of that is completely ignored. It doesn't reduce your pension credit by a single penny. Above £10,000, the department doesn't ask what interest your savings actually earn, because with rates changing all the time, that would be an administrative nightmare. Instead, it applies something called tariff income. For every £500, or part of £500, held above the £10,000 line, the DWP assumes an extra pound a week of income, whether you're actually receiving it or not. £11,000 in the bank adds £1 a week to your assumed income. £13,200 adds £3, because that's over 2.5 of those £500 slices, and any part of a slice counts as a whole one. The honest catch here, and it matters, is that pension credit has no upper limit. Unlike some of the working age benefits I'll come to shortly, a large amount in savings doesn't disqualify you outright. It only reduces the figure that tariff income calculation produces, and if your income, including that assumed amount, still falls below the government's threshold for a single person or a couple, you can still get something. I've met pensioners with 15, 20, even £30,000 put off applying for years because they assumed savings like that ruled them out completely. Often it doesn't. Take a single pensioner whose only income is the full new state pension and who has £18,000 in a savings account. That's £8,000 above the £10,000 disregard, which rounds up to 16 full £500 slices. So £16 a week gets added to her assumed income when the pension credit calculation runs. If her income once the state pension and that assumed £16 are added together still falls short of the government's minimum guarantee for a single person, pension credit tops the difference up. £18,000 in the bank did not disqualify her. It simply changed the sum. The only way to know for certain is to apply, or better still, get a benefits check done first, because pension credit isn't only a payment in its own right. It's a passport to other things too. A free TV licence once you're over 75, help with NHS costs, and in most of the country the route to full council tax reduction as well. Housing benefit and council tax reduction work differently depending on your age and circumstances, and this is where things get properly confusing, so let me be precise. If you're receiving the guarantee credit part of pension credit, your council tax reduction is usually assessed the same generous way, with that £10,000 disregard and no upper cut-off. But if you're of working age, or a pensioner not receiving pension credit and claiming these benefits in your own right, the rules tighten considerably. The disregard drops to £6,000. Between £6,000 and £16,000, tariff income is charged at a steeper rate, and once capital passes £16,000, that's usually the end of entitlement altogether, regardless of how low your actual income might be. Council tax reduction schemes are also set locally, so the fine detail can shift a little from one council to the next, which is exactly why I always tell people to ring their own local authority, rather than assume every age works identically. Here's an honest catch that surprises a lot of couples where one partner is older than the other. If you're what the system calls a mixed-age couple, meaning one of you has reached state pension age and the other hasn't, you generally can't claim pension credit or the pensioner rate of housing benefit as a couple until you've both reached that age. Instead, you'd normally be claiming universal credit together, which uses the tighter £6,000 and £16,000 working age thresholds I've just described, not the far more generous pension credit ones. It's caught out plenty of couples who assumed that because one of them was drawing their state pension, the whole household had moved on to pensioner rules. It hasn't, not until the younger partner catches up, and the difference in what you're entitled to can be considerable, which is exactly why it's worth checking rather than assuming. If you're finding this useful, do subscribe and turn the bell on so you don't miss the next one. I go through this stuff in plain English so you don't have to wade through 40 pages of gov.uk yourself. What actually counts as capital trips? People up more than the thresholds themselves. It isn't only the obvious current account and savings account balances. Premium bonds count at face value, whether or not you've ever won anything. Stocks and shares, including ISAs, count at current market value. A second property, if you own one and don't live in it, counts. Money in a joint account is normally treated as belonging to you equally with the other holder, even if in practice one of you put most of it in. And a lump sum from selling your home, or an inheritance like Doreen's, counts the moment it lands, not the moment you decide what to do with it. Money set aside in a funeral plan is normally disregarded, and so is the surrender value of most life insurance policies you haven't cashed in. But a caravan or holiday chalet you own and don't live in generally does count at whatever it would fetch if you sold it. What generally doesn't count is the home you actually live in, a pension you haven't started drawing yet, and certain compensation payments for personal injury, at least for a period. If you're not sure whether something you're expecting counts, that's exactly the kind of question a benefits advisor or the pension service can answer for your own circumstances, because getting it wrong in either direction causes problems. Sometimes that's an overpayment you'll eventually have to pay back. Just as often, it's a pensioner under-declaring out of caution and missing money they were owed all along. It's also worth understanding the difference between the pot itself and what it earns. The savings sitting in your account are capital, assessed the way I've just described. The interest that account pays you is technically income, but for pension credit and housing benefit purposes, it isn't counted separately on top of the tariff income figure, because the tariff income calculation already stands in for it. You don't get taxed twice on the same pound through the benefit system, even though the tariff income rule can feel harsh if your actual interest rate is a good deal lower than £1 a week per £500 implies. Now, to the part of the title that probably brought some of you here, the idea that the DWP is watching your account. Both a myth and a reality exist in this space, and confusing them helps nobody. The myth is that some official sits somewhere scrolling through your bank statement, watching what you spend at the weekly shop. That has never been how it works. What has actually changed is that the government now has powers under recent fraud and error legislation to ask banks and building societies to run automated checks against accounts linked to certain benefit claims, flagging patterns that might suggest someone holds capital above the relevant limit without having declared it. It's an automated data match, nothing more dramatic than that. The bank isn't handing over a full transaction history for a person to read line by line. It's confirming, in a fairly blunt yes or no way, whether an account looks like it might be carrying undeclared capital. This power sits within a wider piece of fraud and error legislation Parliament passed to reduce the billions lost every year to benefit fraud and simple mistakes across the whole system, not something aimed specifically at pensioners. The catch worth being honest about is that this is still being rolled out in stages. The safeguards around it are still being tested. Campaign groups have raised real concerns about privacy along the way, and the fine detail of how it works in practice may keep shifting for a while yet. What won't shift is the underlying principle. If you're claiming a means-tested benefit and your genuine capital sits under the relevant threshold, none of this touches you in the slightest. It exists to catch undeclared money, not to punish honest pensioners for having a savings account. Which brings me to the mistake I mentioned at the start, the one that causes more grief than almost anything else here. Some people, once they realise their savings might reduce or end a means-tested benefit, decide the sensible move is to give some of it away, perhaps to a grown-up child, perhaps into a grandchild's account so their own balance looks lower on paper. I understand the instinct completely, but the DWP has a rule for exactly this situation called deliberate deprivation of capital. If they conclude, looking at the timing and the circumstances, that you gave money away specifically to drop below a threshold and qualify for more benefit, they can simply treat you as if you still had it and assess your claim on that basis regardless, while the money itself is really gone from your hands. You end up with neither the higher benefit nor the money. It's one of the cruelest traps in this whole area precisely because the people who fall into it are almost always trying to do the careful, sensible thing. If you've got savings and you're not sure whether they affect a benefit you're claiming or thinking of claiming, the answer isn't to hide the money or move it around. Get an honest calculation done instead. Free independent benefits calculators through Turn to Us and Entitled To will ask a handful of questions, take about 10 minutes, and tell you, based on your actual figures, what you might be owed. Age, UK, and citizens. Advice both offer benefits checks too, done by a real person over the phone or face-to-face if you'd rather talk it through than fill in a form on your own. And if it turns out pension credit is something you could be claiming and aren't, it's worth doing properly, because on the DWP's own figures, a large number of pensioners who qualify for it never apply, often because they assume their savings or a small workplace pension would rule them out. Frequently it doesn't. And if a decision does go against you and you genuinely believe it's wrong, you're not simply stuck with it. Every DWP decision on pension credit, housing benefit or universal credit comes with the right to ask for what's called a mandatory reconsideration within 1 month, where someone who wasn't involved in the original decision looks at it again with any evidence you provide. If that still doesn't resolve it, There's a further right of appeal to an independent tribunal at no cost to you and without needing a solicitor. It's a route worth knowing exists, even if you never need it, because a good many people simply accept a wrong decision rather than question it, when a phone call and a bit of persistence would have put it right. The other thing worth doing costs nothing but 10 minutes, and that's keeping a simple record of where any large sum in your account came from. Inherit money and keep the solicitor's letter. Sell something valuable and keep the receipt. A relative gives you a gift, a short note with the date, and the amount is enough. A single envelope or a folder on the computer, labelled something as plain as where my savings came from, is all it takes. It sounds like an unnecessary chore right up until the day a letter like Doreen's arrives, and then it's the difference between replying with one email and an attached document, or spending 3 anxious weeks trying to reconstruct where £4,000 came from 8 weeks after the fact. Quick note before you go: this has been general information to help you understand how these rules work, not personal financial or benefits advice, because everyone's situation is genuinely different. For your own circumstances, a free benefits check through Age UK, Citizens Advice or the Pension Service will give you an answer specific to you, and it costs nothing to ask. I want to leave you with the same thing I told Doreen once her letter was sorted. None of this exists to catch people like her. It exists because the system cannot tell the difference, on paper, between an inheritance and undeclared capital, unless somebody explains which one it is. Knowing the rules, knowing what counts, knowing your own threshold, and keeping a little paperwork alongside your savings is the entire difference between a letter, like that being a 2-minute formality or a month of needless worry. Your state pension was never at risk from any of this. What was at risk, for Doreen and for anyone in a similar position, was simply not knowing which parts of the system were watching, and which parts never were in the first place. Thanks for watching to the end. If you found this useful, share it with someone in the family who'd benefit. These are exactly the rules that matter most to the people who never hear about them. Check the current figures for your own situation before you act on anything, since thresholds and rates do get reviewed. See you in the next one.